Understanding different order types in stock trading. You've identified a stock or ETF for investment and decided on the number of shares to buy. Now it's time to place the order, a task that can be daunting for novice investors due to the need to select an order type. Order types are essentially instructions to your broker on how to execute your trade. While you don't need to know the intricate jargon or hand signals once used on the New York Stock Exchange floor, understanding the basic order types and their impact on your trade is crucial. Placing an order. First, how is an order placed? When you select buy or sell, your order is sent to your broker, who attempts to execute it on the market. Prices can fluctuate continuously, and the system for routing orders is complex, affecting both the speed and the price at which your order is filled. Choosing the appropriate order type can significantly influence these factors and determine the success of your trade. Therefore, understanding the main order types is essential. Market orders. Starting with market orders, this type indicates that you want your order executed immediately at the next available price. In rapidly changing markets, the next available price might differ from the quoted price when you place the order. Investors using market orders generally prioritize the speed of the trade over the price. The lack of price restrictions means this order type is most likely to be filled, but also carries the risk of execution at an unintended price. For instance, if prices are dropping and many investors are selling, the price could fall further by the time the market order is executed, potentially resulting in a lower sale price than intended. Similarly, placing a market order after trading hours could result in a different price when the market opens. Hence, investors usually use market orders during trading hours and in highly liquid markets to enhance the likelihood of getting an order filled close to the desired price. Limit orders. If your priority is to buy or sell at a specific price or better, a limit order might be more suitable. With a limit order, you specify a price, and the trade will only be executed at that price or better. However, due to the price restriction, there is no guarantee that the order will be filled quickly or at all. Investors typically use limit orders when they have a target entry or exit price and are willing to wait for the market to reach that point. For example, if a stock is trading at $55 but an investor values it at $50 or less, they could place a limit order to buy at $50. If the stock never reaches this price, the order remains unfilled. Conversely, if the stock drops to $50 or below, and there's sufficient volume at that price, the order will be executed, allowing the investor to purchase at $50 or less. Stop orders. The final order type is a stop order, essentially a market or limit order with an activation price that triggers the order. When the stock hits the activation price, the order is executed according to its type. Stop orders can be utilized in various ways, such as buy stop orders for purchasing securities when they reach a certain price or sell stop orders to limit potential losses. For instance, an investor might set a sell stop order for a stock, specifying that if it falls to a certain price or lower, it will trigger an order to sell at the next available market price, potentially preventing further losses. Types of stop orders. There are three types of stop orders: stop market, stop limit, and trailing stop. Using a stop market order, when the trigger price is reached, an order will be placed to sell at the next available price. The advantage is that it may help the investor exit a falling position quickly, though the next available price could be lower than anticipated. With a stop limit order, reaching the stop price triggers an order to sell at the limit price or better. This offers price control but carries the risk that the order might not be filled if the stock falls below the limit price. Lastly, a trailing stop order involves setting a trailing amount, a specific dollar amount or percentage away from the market price. For a long position, the trailing stop is set below the market price to lock in profits as the stock rises. If the stock price increases from $100 to $110, a trailing stop set at $5 below would rise from $95 to $105, maintaining the $5 distance. If the stock begins to decline, the trailing stop remains at $105, minimizing potential losses. Conclusion. Each order type has its advantages and disadvantages. Investors should plan ahead and determine the most suitable order type for their specific scenarios. Understanding how market orders, limit orders, and stop orders function can be instrumental in executing successful trades and achieving your investment goals.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.